All right. Excuse me. Sorry, guys. All right. This is going to be the first video of 5 or 6. I'm not sure if it's going to be 5 or 6, but it's the first of at least 5. And it is going to be for your ratio slide. Now, let me just discuss a couple things with you prior to me starting the actual lecture on this. Your ratios are under topic 3 on the Vanco Hall for you. Now, these are ratios that are used in the financial world to tell whether a stock is performing well. It's used by businesses to check how much money they're making. So these are slightly important ratios that you're learning. Now, the key about these ratios is normally in a regular time, you would have to memorize all 20 of them. And then you would come in and take an exam where I would give you a bunch of numbers, and you would have to go ahead and do that. Now, with pandemic time, I can't control what you guys do on your own time when you're taking the exam or test on this. But I will say that for those of you that are in a 4-year program, and this is another step in the staircase of college, you probably will end up having to take financial management with, this is Sturdivant. Now, Sturdivant's financial management class requires you to know these ratios when you get there. There's 2 topics that we cover in managerial, and you're on the first line of teaching them to you. And then she broadens a little bit further on them when you get to her. The first of those 2 topics are the ratios that we're going to be going over now. The second topic is what chapter 14 is all about, which is the statement of cash flows. So 2 topics that I really cannot stress enough to you that are very important for you to pay attention to and to understand, because you are definitely going to be using them again. If you're in one of the 4-year programs, I know hospitality, I believe, pretty sure takes the financial management class, or hospitality finance. They cover these ratios. Okay, and during the slides, I'll try to give you some helpful hints and tips about them. I'm going to try to break them down to help you memorize them. Although I know that none of you guys are going to, but the key here is that at least I would hope that you attempt to. I will try to give you every little helpful hint that I have. And again, it takes a little bit of practice. It's going to be a little know-with-all, but we will get through it. The key here is that there is going to be a quasi-test on it, but it will be limited to a time frame that you will have to do it. It'll be a little bit shorter than the full day that you had on your first exam, which I'm still in the middle of processing and grading. But the key here is that you have to make sure that you pay attention to this, okay? I will give you tips and go through things with you to try to explain how to get the ratios together properly. For those of you that have already tried starting them, I wish you had not, but I'm not going to hold that against you. I do expect that you guys to watch these videos. I'm going to break them up into sections for you to make them easier. Okay, so with that being said, I'm going to put up, now that I'm talking and getting through this, I know I'm going to put up a 6th video, which will be the directions to follow, but the first 5 are just going through the actual ratios themselves. So with that being said, let's start right off on the top there. Liquidity ratios. Now, keep in mind, liquidity is the ability to pay your bills when they come due. Now, not every company is liquid, so to speak. Not every company has money when their bills come due. That does not mean that they're a bad company, okay? You could have $1 million worth of sales, but if everything was on account, meaning somebody owes you something, you're at the mercy of whenever the accounts pay you. So you could have great sales, you could have a great profit margin, you could be completely making money, but if your customers are not mailing it in, then obviously it's a problem with liquidity. So keep that in mind when we talk about that a company cannot be liquid, but still be profitable, okay? So with current ratio, now the first ratios you see there, I can break this ratio down into 6 letters. The ratio that you're preparing first is your current ratio. And that's your current assets divided by your current liabilities. So in other words, it's CR, current ratio, equals CA, current assets, divided by CL, current liabilities. Now, when we say current, that doesn't mean go to your balance sheet and grab all your assets and throw them on there. When we say current, you have to know what the definition of a current asset is. So if you take a look at the Excel spreadsheet that accompanies this problem, take a look at our just the accounts that are assets. There are 4 of them. We've got cash, accounts receivable, inventory, PP&E. Now, you need to first know what a current asset is. And the same rules go for current liabilities, except they'd be liabilities. So anything that's current means that it's going to be less than a year and can quickly be converted to cash. So if you take a look there, just for your own sake, count how many current assets you see under the assets on your balance sheet. And some of you are going to say 4, some of you are going to say 2, but the real answer and the correct answer is actually 3. Cash, accounts receivable, and inventory are all what we consider current assets. So you've got to make sure that you're using the right numbers. So to get your current assets, you're going to add those 3 numbers together to get your numerator in this question. The second part talked about getting your current liabilities. So if you take a look at your liabilities section, you would see that there are 3 things listed there. And you know they're liabilities because of what word? And hopefully right now you're saying to yourself, anything with the word payable. So we got accounts payable, notes payable, and bonds payable. So in your mind, I want you to say to yourself, well, how many of those are short term? Well, hopefully you said 2. Accounts payable is definitely short term. And then we've got notes payable, and that's telling you that's short term. Now, the real question that comes into play is, why is bonds payable not short term? And this is where I say that accounting is cumulative by nature. I'm not asking you to, on your final exam, remember what you did the first week of class, but I am asking you to keep track of concepts. So one of the definitions of bonds payable right off the bat is that it is long-term borrowing. Okay, it's for multiple years. So that tells you right off the bat that that's not a current liability. So you would not add that number in. So for your current liabilities, it would just be the 2 of them, the 1047 and 50,000. So it's very important that you pay close attention to what each ratio is asking you for and only use those numbers. Okay? It's very easy to slip a number in there. The other thing that I would like you to do when you're doing ratios is do each calculation twice. Okay? You guys and gals can probably type on your phones a text message or whatever in next to no time. Okay? Well, that's how I am with a calculator. And you will get there if you use a calculator enough. But the key here is I want you to make sure that you're getting the right numbers. Okay? It's disheartening when I can see that you guys write the information out and then you go and you put the wrong number there. You understand what I'm saying? So just take the extra 10 seconds. 10 seconds to type in, 15 numbers? And I mean individual numbers like 150,700. That's 6 numbers right there. You know what I'm saying? So it doesn't take a lot to do it. Just take the extra 10 seconds and verify your numbers. Okay? When it comes to rounding, typically I want you to go 1 to 2 decimal points. Okay? For some of you guys, you're going to say, oh, I rounded it to the tenths. You rounded it to the hundredths. Well, is it going to be that big of a difference? In some cases, it could be. 0.01 is a big number to us when you're talking about billions of dollars that companies can make. Okay? So, yes, it's not much when you're talking in the hundreds of dollars. But when you start talking about millions and billions of dollars, that 0.01 means a lot on their income statements and balance sheets. So I always suggest, and I try to get you guys to round to 2 decimal points. The only items that I don't want rounded to decimal points that I want rounded to the nearest day is when we go ahead and we figure out the days for something. And I'll explain more about that in a minute when we get to the fourth ratio under liquidity. So going back to the current ratio. The current ratio, very easy. Again, CA divided by CL. Okay? The next ratio that we're going to be working on is what we call our quick ratio. And our quick ratio is very similar to our current ratio. You start off with cash, which is a current asset. And according to this, you add marketable securities and receivables. Now, not every company will have marketable securities. So it's for you to pay attention on the balance sheet. You can only go by what they have on the balance sheet. Okay? So here you're looking for those three accounts. And you're going to put the cash. And in this case, there is no marketable securities. So you're going to do cash plus receivables. And then you're going to divide by our CL again. So you could just go simply back up to the first ratio, grab the denominator, and bring it down to the next question. Okay? Next one we're going to be talking about is our receivables turnover. Okay? Turnovers are always 1.1 to 1 type of thing. It's always to 1. Okay? And what I mean by that is when you get your answer, if your answer says 2.1, you guys have all seen what a ratio looks like. It'll say 2.1 semicolon 1. It's 2.1 to 1. So for every dollar, we got $2.1 type of thing. So I would appreciate if you guys learn to write that out that way. So receivables turnover is net sales divided by average accounts receivable. Now, net sales, the word sales automatically talks about income statement. You should know that that's on your income statement. And net sales is the same as net revenues. In this case, it's already netted. So if you see just the word sales, look for those types of numbers. So you go to your income statement and find that. Now, here's the tricky part. Our denominator says we need our average accounts receivables. Okay? Now, it's not a hard thing if you know what you're doing and you got to pay attention to do it. It says you need the average accounts receivable. Well, to get an average, you need multiple numbers. So for what we need is we need the beginning of the year's value and we need the ending of the year's value. Now, we don't have a beginning balance here. It's not given to us. But what we do have is we have last year's, because you're looking at a comparable balance sheet. And the example that I want to give to you is pretty simple. It's New Year's Eve. You got $1,000 in your pocket. It's December 31st. You're rocking it out home all alone. Nobody in your house. You go to bed at 11:30. You don't even stay up for the ball. You wake up the next morning, which it's now January 1st, the next year. How much money should you have in your pocket? You should all say $1,000, unless you're married. Because if you're married like I am, my wife loves my pockets. And not when I'm in my shorts either. She likes to go in and grab money and run. But then again, it is what it is. I don't mind because, that's the wifey. So, happy wife, happy life. Just remember that. So here's the key here. The average, what you need to do is you need last year's ending, which is this year's beginning. So, for instance, if we're ending 2013 with $1,000 in our pockets, we're going to start 2014 with $1,000 in our pockets. So that's your beginning number. Then you go on to the next number, which is your ending, which is the ones that are given to you on your balance sheet or prospective statement that you're working on. Okay, so to get the average, now that you've got the two numbers, you need to find the average. So that would just simply be to add them up and divide by 2. That gives you your average. And then you go ahead and use that number and fill it into your equation, and you will get the answer by properly filling out the equation. Number 4, it talks about days sales uncollected. I'm all discombobulated today. See what I mean? Days sales uncollected. Now, whenever you see the word days in the title for the ratio, your numerator is going to be 365. Very, very simple. It's going to be 365. And in this question, it says days sales uncollected, 365 over, and then it says receivables turnover. Well, the lucky part for this is you just did the receivables turnover, which was ratio number 3. So the answer to number 3 gets moved down to the denominator of number 4. And this is one of those ratios where I want you to round it to the nearest day. Okay, where we don't talk about quarter days, half days, 3/4 days. No, we talk about in full days. So number 4, just make a little note that you're going to make that into days, actual physical full days. So if you get 60.4, it's going to be 60. You get 60.6, it's going to be 61. Just round to the nearest whole day for that one. Okay, and it's pretty easy because you just use the answer from number 3 and you divide that into the 365 to get your number of days. Number 5 talks about inventory turnover. Now, inventory turnover is something that we like to use in the retail world. Now, my question to you is, do you want a high inventory turnover or a low inventory turnover? Hopefully your mind said, well, if I turn my inventory over, which means I sell my inventory, the more I sell my inventory, the more money I'm making. So it's a good thing to have a high inventory turnover. So to get that ratio, you simply get your cost of goods sold, which is located on your income statement. And here you're going to divide by average inventory. So you're going to go find the average inventory the same way you found the average accounts receivable up above. You're going to do the exact same thing, finding the average inventory. So last year's ending is this year's beginning, and you'll be given this year's ending. So you add the two numbers up and divide by 2, which would give you your average. Then you take that number and plug it into this equation, and you complete your calculation and write your answer down. Okay? Next one, number 6. It says days inventory on hand. How long did that inventory sit on your shelf? And we all know that the longer the inventory sits on the shelf, the less likely you are to sell that inventory. So that's where big discount ticket items come in for next to nothing on sale. Okay? They want their inventory out. The longer it sits there, the less money they're making. Now, again, the first word in the ratio was days. And I told you that whenever you see the word days, you're going to use 365 as your numerator. And in this case, days in accounting period would be 365. And then it says divide by inventory turnover. Well, that's the answer from the question we just did. So 2 times in a row, we're going to do the turnover ratio. And then the days ratio is dependent on the turnover ratio. So you got to do your ratio first to move on to the next set, which is the ones that have the days in it. Okay? So it's pretty easy to do those. The hardest part, again, is if you screw up the turnover ratio before it, you're going to end up with a screwed up number for your days turnover. So pay close attention when you're doing that problem. Again, you can stop my videos and you can go ahead and do something. You just please, please, please get this. Okay, it's very important that you understand this. The last 2 under liquidity. First one is called the payables turnover. How quickly money that is owed to us gets paid. And what you need for that, and this is a little tricky, is the first part of your numerator is cost of goods sold. Now, we've already gotten that number from somewhere else, but by now you should know that that number is located on your income statement. The next number is the tricky number. This is the one where you have to say to yourself, okay, what exactly am I looking for? And in this case, you're looking for merchandise inventory, which is another word for just inventory. It could be listed as merchandise inventory or just as inventory. And in this question that we're doing, yes, the ratio says merchandise inventory, but it's listed as inventory on your balance sheet. So what you need to do to be able to do this question is, it says you need to find the change, meaning how much did it change from the beginning of the year to the end of the year. So for instance, if you start off the beginning of the year with $5,000 worth of inventory, and at the end of the year you have 12, your inventory went from 5 to 12. So it went which direction? It went up. So if it went up, that means you're going to add. So first figure out what you're going to be doing as far as adding or subtracting